low price relative to the price of corn. So we've got here is a chart showing the ratio of distillers dry grains on a dollar per ton basis relative to the price of corn. And I took the dollar per bushel, converted to dollars per ton. So this is a straight up ratio of the per ton price of distillers to the per ton price of corn. So from a feed value perspective, distillers has similar energy and higher protein than corn. So from a cattle feeder perspective, if the price of distillers was less than the price of corn, it should be an attractive feed additive, in part because it gives the same energy, it gives more protein. So from supplementing either low quality hay or supplementing or augmenting silage or some other feed that's of lower quality than needed, distillers would have a nod or be preferable probably anytime the price, this price ratio was below 1. Now, last year at this time, price ratio was about 1.2 to 1. So distillers was more per ton or substantially more per ton than the price of corn. The last few months in South Dakota, so this is South Dakota corn to South Dakota distillers prices, that price ratio has been down 0.85, 0.9, 0.91. So distillers have been very affordable as far as an energy cost or energy input the last few months. I thought I was on to something, but in the last couple of weeks, here in September again now, even though the price of distillers is fairly close to last year, price of corn has crept up a little bit, and that ratio is very close to 1 right now in the middle of September. So monthly prices have been looking good, but in the last couple of weeks, distillers, the ratio of corn and distillers has tightened up again. So it might still make sense to look at distillers in a ration because of the fact it brings protein along with it that's not there in corn, for example. So another price to kind of keep an eye on or monitor if this thing would happen to drop back down might lead to an opportunity to lay in some distillers. That was all I had formally. I just wanted to highlight some of the comments and things that I've discussed here today. I've also written up and included in this month's or this week's issue or version of In the Cattle Markets, which I help contribute to. That's posted on the LMIC website. You can also find a link to that on the extension.sdstate.edu website. That's it for my prepared comments. The only other one that comes to mind, I did do some additional looking at the corn situation. There's some carry in the corn futures market, but I doubt anybody's going to be too anxious to do much in terms of pricing corn, just given the situation we're in with the likely delays in harvest. But the carry that's there would suggest purchasing corn, laying it in, storing it yourself, rather than doing anything too crazy in terms of protection or, for example, buying call options to protect against higher price of corn. You're kind of getting penalized twice with that carry in the market to go from that standpoint. So volatility is not too high in the corn market. So if you are nervous about prices next spring, it might be something to take a look at. But I would use the options market and go with an out of the money call option on corn. That's it for the comments. Heather, I see you there. Have we had any questions? I haven't been able to monitor the chat.
I don't have any questions that have been typed in so far. Anyone interested in asking a question, have a question that came up to ask Matt as we go forward? You can either unmute your microphone or type them into the chat box. Well, I'm not seeing very many questions come in, so Matt does have his contact information there. If you have any questions for him, I'm sure he'd be more than happy to answer them at some time for you.
I do have to at least probably log, or I may not log off entirely, but I'll monitor chat if there are additional questions. But I'm hosting office hours here at this time, so should a student come along, I'll need to give them my attention. But thank you for your attention today, and look forward to future dialogues. Thank you.
Okay, thanks, Matt. If you could unshare. So the next thing we're going to go into is kind of a look at the cull cow market and some management components that way. As I'm trying to give this presentation, I don't think I have the availability to see the chat session. So if you have questions as you go through, either type them in and we'll get back to them, or we can take them all at the end. So we'll just kind of run it from here. Thank you for everybody for taking time to attend today. We greatly appreciate your efforts on all of the dialogues that we've had for the last several months here. So as we start this look into the cull cow component, and this didn't work earlier, so fingers crossed. Here we go. Here's the main reason why we want to really look at that cull cow marketing and maybe look at her as a component of our operations as a financial resource and not just something extra that we have around. They do account for roughly 20% of that cow income for our farm and ranches. And, you know, given today's pricing situation, that might even be higher if we have low corn crops and those types of things. So putting our efforts and allocation of resources into an enterprise that's going to make us some money, or maybe selling cows right away is the best option, is really what we need to be looking at so that we're getting the biggest bang for our buck there. So I have a silage pile shown in that picture. When it says resource allocations, you know, I'm not just talking about feed resources, but we also need to be talking about inputs of time and labor, how much cash we have available for supplement purchases and those types of things. So we're going to try to cover all of those in the next half an hour that we have to spend here and to look at things. The biggest thing that everybody wants to know is, you know, let's look at the seasonality of markets. There is a lot of seasonality in the weigh ups and in the cull cow market. If you look at this slide, we have the 2014 to 2019 seasonal price index here. And you can really see a lot of that seasonality. Prices really tend to be higher here in the summer months. And then we have that seasonal drop off in the late fall and winter months, and generally when we're doing most of our peg checking and those types of things in this area. So just to kind of point out a few things on this slide, it is an index. It's not the actual prices received for cows in different months. It gives us a better comparison of what those seasonal swings are. And this is also from the Sioux Falls Regional Livestock Market for breakers ranging from 1,200 to 1,600 pound cows, just so we kind of know where things at and what we're actually looking at when we're making these comparisons. Another thing to look at on this slide, not only is the highs and lows of the market, but we can look at that variation. If we look at the standard deviation, either plus or minus from that average, we have a time frame in August, you know, July, August, that's very narrow compared to that December time frame where our variation in prices is much higher. This is one thing that kind of plays into making those budgets on whether we're going to keep cows for the next year and feed them out, or if we're going to sell right away, you know, if we're going to sell those cows straight off. You know, that variation in December, if you're trying to put a price on what's the value of my cull cow today, we could be off by a bunch when we're making those estimates because of the wide variation. You know, we've got, you know, from 90 to 105 there. So that's a big, you know, $15 worth back and forth. in that price variation fluctuation there, versus up in that trying to estimate what they're going to be worth in April, May, or June, July to keep them that long, as we try to put these budgets together in the future. So it makes it a little harder, but doesn't mean that it's impossible to do. Just something to keep in mind and really be paying attention as we move forward with our budget creations. Some of the things that play into the prices of the cull cow markets, in addition to what the fed cattle market is doing, is that beef in cold storage. Sorry, not and cold storage, but beef in cold storage. What heifer slaughter numbers are looking like, and how the dairy slaughter numbers are adding into the total numbers of cows hitting the markets. So each of those a little bit, we can see the beef in cold storage here. We had kind of an uptick when this was updated in July. It was about a month earlier than what that 2013 to 2017 average is, but follows the 2018 trend pretty close there. So there is has been an increase in beef in cold storage. So maybe we're not, as we hit that number that's higher than average for the first time here this year, maybe that's some of our challenge with looking at prices of not only fed cattle, but the cull cow market as well, as we're looking at way ups. If we look at our heifer slaughters numbers, these are the federally inspected numbers on a weekly basis. So you can see that 2019 number there in the light blue. It's a solid line, kind of hitting some big numbers there in that 190,000 category, which is about 100 or 10,000 more than we had been in a year prior, and pretty high above that 2013 to 2017 average. So we're not really looking at an expansion type of situation when we're sending that many heifers to market. So there is more beef available for the buyers headed to market back and forth. The last number we have to look at are the weekly federal inspected numbers for total cows headed to slaughter. Again, we're looking at the 2013 to 17 average and the 2018 and 2019 numbers. This summer, we've been pretty close to the 2018 numbers headed in of that, right around that 120,000 head range, with about an even division of those being dairy cows and beef cows. So kind of a 50-50 mix there headed through the markets. One maybe good sign is that milk prices have gone up about $1.50 a hundredweight on the national basis. So maybe that'll take away some of that pressure on prices as dairies are able to maintain cow numbers, and they're not culling as hard, pushing more beef onto the market as we go forward. So those are a couple of the supply and demand sides of things. As we get into some of the cost considerations and where we need to look at that, I took this little snapshot off of the SDSU beef cattle budgets. What does it really cost you to raise a calf on your operation? Because those are the numbers that we need to know in order to determine how we're going to market calves, and also looking at if we have a cull cow standing on our place that didn't raise a calf, how are we going to get some value out of her, and how much do we need to get from her? So putting those together, it's one spot to start our marketing plan, and if we can come up with a plan that sells her today and we get $600 for her, maybe we did pretty good. If we can come up with a plan that makes $800 on her when it costs us $681 to raise that, feed her for that year, maybe that's something we need to be looking at there as well. So we need to be looking at turning this into an enterprise and not just having cull cows around that we have to do something with. So here's an example feeding budget and some things that we need to be thinking about. You'll notice that I didn't put any numbers into those boxes, and that's on purpose. Everybody's operations are a lot different from the next guy's, and as soon as I start putting numbers in there, everybody just, when I get phone calls later, they're like, well, this is what you said it was going to cost. Well, it was based on my sample farm, but maybe not the best numbers for you. So you really need to take a look at these different components, figure out how many days you're going to feed the animal, what's your target end weight, and then determine what that estimated average daily gain could be. How many pounds of total gain is it going to be there? What's her estimated cost of gain? What's she weigh now? What's the animal going to weigh when you send her to market? And we talked about that estimating the selling price when we're going to sell them at whichever given date in the future compared to what we could maybe sell them for today. Those all go into those decision-making processes. So determining that estimated total cost of gain, figuring out how many pounds of feed we need, that's going to be one component of our inventory and that creation so that we have that all figured out. We need, labor sources aren't a component of this feeding budget, but that's also one thing that we need to be considering is, do we have labor available when these cows are going to be on hand, or is there a better spot to allocate our feed and labor resources as you move forward? So I took a couple of these budgets or these rations here, diet A, B, and C, came from chapter 48 of the SDSU Extension Beef Cow book. And they kind of give you an idea of what a ration might look like that you're planning on feeding those cows. Anywhere from corn with corn silage, distillers grains added in, different hays and adding some supplements in there. You'll see that the supplement is added in each of the ration, and one of that component is to ensure that the vitamins and minerals are appropriate. But we also have an ionophore added in that supplement as it went forward to increase your average daily gains and your feed to gain ratios. Because if we're going to feed this cow, we want her to be as most efficient as possible moving forward, so that she's not a drain on our economic resources, but really helping to boost the income that we have from our operation. One of the conversations about gain comes up on how much gain will a cow get, or what can I expect from her. There's been studies on SDSU research that anywhere from 2.8, 2.9, and 3.1 pounds per day was found on cows that were fed for 50, 77, and 105 days. So they're showing that they can gain some weight on a per day basis. Other studies over 90-day feeding periods found cows gaining anywhere from 3.6, 3.5. So if we can get that for an average daily gain, we can put on some pounds and change body condition scores of the cows that we're feeding. These three rations that are listed on this slide, they don't include just roughage grazing. So maybe we're grazing corn stalks or some of our prevent plant acres that we've got different forages planted in and crop residues. So making sure that we're looking at that as an option, if that's something that works for you, is also something that could be done. Really want to make sure that you're watching the protein supplement that you're providing the cows so that they can utilize that forage in the best manner possible. Use them to clean up behind the, out in the cornfield. And where you maybe have been using 1 acre per cow for a gestating cow, as you're trying to figure out how many acres you need, maybe you want to bump that up a little bit for these open and cull cows, so that you're ensuring they're getting enough corn that they're actually making a 2 or 3 pound per day of gain as you move forward with them through your cattle rations here. So not every cow on your place might qualify as a good cow to feed as a cull cow. So types of cows that we want to be looking at feeding are sound and healthy. Obviously, those are the ones that are going to be your best impact on increasing your income and your profits. We also want them to be in a thin to moderate condition. If they have the ability to gain 100, 150 pounds, put some of that weight on and add value to what you're trying to do for the feed that you're putting into them, those are the cows that you really want to consider. Say if they're in a condition 3 or 4 body condition score, those are cows that you can add weight to if they're healthy and have the ability to gain at that 2.5 to 3.5 pounds per day. And then the bottom bullet there says open cows. You really want to make sure that you're doing your preg checks. Open cows are going to bring you the most bang for your buck in your cull cow operation. The flip side of that is what cows not to feed. So obviously anything that's unsound or injured, you really want to be considering selling straight to your packer. Those cows probably will not gain and will end up costing you more in inputs as you move forward. So looking at a direct market for those cows right off. Also, if you've got unhealthy cows around, if something needed to be treated, make sure that you're double checking your medicine labels and looking at those withdrawal dates. That's very important to the whole industry, not just the things that you're doing at your operation. So make sure you're looking at that. If you have cows that come up open and their body condition score 5 or 6 or better, that white cow in the picture there, she's probably a 6 or better. She did really good on nothing but grass. Those cows probably don't have a lot to gain. So whatever you put in her for feed resources might be better allocated to some other animals on your operation. And take what you can get for a market price for her now, because even if you save her, she might actually lose weight on you depending on the condition, the feed conditions and resources that you have available this fall and winter. And the last bullet, contrary to the opens in the last slide, that pregnant component is kind of huge. Pregnant cows, the nutrients that you put into her are going to go towards maintaining that calf and growing that calf. And then you have the flip side that when they slaughter that cow, your dressing percentage is going to be much lower. And that's always allocated in the price that you receive. The buyer and the packers are very aware of that, and they're going to drop what they're willing to bid on your cows if you have pregnant cows come through the ring. So those are some of those what cows not to feed. So some of my management take homes as we kind of wrap this up a little bit. The biggest thing, don't cut out costs that may save you money. Sometimes we have to spend money to make money, and in economic situations that we might be in this year, it's really easy to try to say, oh, I'm not going to preg check. But if it's costing you $300 to feed a cow over the winter, if she's open, maybe she needs some completely different feedstuffs, and you can save and allocate those high quality forages for cows that are planning on making you some money. The same way goes for vaccinations. Instead of cutting on vaccinations for your calves or not preconditioning them, make sure that we're doing good management practices to the best of our abilities when finances are tight and the economic situation isn't as green in the bottom of our balance sheets as we may like it. Use your dewormers, use things that are going to make you money in the long run that have been shown to have good economic returns. Take a look at the kind of cull cows you have. If your cows are coming off a green pasture, since we've had this blessing of rain this year and pastures are generally in pretty good shape, and your cows are already in good condition and just to be blunt, they're fat cows and they look good. Maybe this year we don't feed cull cows. Maybe this is the year that we move them off and utilize all of our high quality forages and the resources that we have available to ensure that our pregnant cows are fed and maintained in the best possible condition. And we use the income that we get this fall from those cull cows to make sure that the calves that we kept or retained ownership on, or heifers that we're trying to develop, we get them done right this year and not put those time and effort and funds towards the cull cow enterprise. Here it says evaluate your market potential. Really look at those budgets, look at different feed rations that you have available, and really look at that as inputs versus your income potential. If it's costing you more inputs than what you have potential for income to get out of those cows, maybe we get out of them sooner than later, and really look at the red lines versus black lines in your budgets. Follow the money on this one and and make the best decisions there. So, make sure you're culling the right cows, or you're feeding the right cull cows. If they're thin, let's put some weight on them if we can. If they're already in condition, let's move them out and take advantage of the ability to put inputs into some other of our enterprises and our animals. Inventory your resources. Again, I've got a bale of hay there. Go count your bales. How many grazing acres do you have available this fall? How many of those acres will you have if we get an early snowfall or something else like that hits? This year, it's hard to say what the weather is going to do, so make sure that you're looking at what plan A, B, and C might be based on inventory. And not only count the bales, but take those seed or those feed samples, know what you have out there in the bales. If you're trying to balance rations without knowing the feed value in a bale of hay or in your silage pile, we're really doing a disservice to what we're actually trying to accomplish. We got to know what those nutrients are in each of those feedstuffs available. How much cash is available? Another hard question to answer in times like this, but do you have the funds available to buy the appropriate vitamin mineral packages? Are there dollars available for ionophores so that we're increasing our efficiency and maintaining average daily gains as we move forward? Do we need to buy additional hay or forages or rent more ground to graze? Those types of numbers all come into play, and we really need to know how many cows we're going to end up feeding, thus the preg checking and those types of things early on, and know what you're going to need for feed resources, and do you have those on hand? And if you don't have enough feed resources, where's the best spot to put your dollars for increased income? Is it into the cull count enterprise, or do we put it into our pregnant cows that need to be increase their plane of nutrition as we move forward? And the last thing, when you consider that inventory, make sure that you're inventorying your labor. Who's going to be available to feed cows, move cows, as you move forward, trying to get the biggest bang for your buck out of these cull cows. Now until they go to the sale barn, where are you going to put them? Do you have enough pen space? Given the mud situation, do we have good pen space, or should we be saving or trying to put those lots into better condition for cows this winter, for your pregnant cows? So, take a look at all of those components that tie together that maybe we don't always have to deal with, but given this year's marketing situation and weather situation, we might do things a little different than we have in the past. And the last bullet there says follow your plan. After you've made the decision to feed cows, you've kind of put a plan on how many pounds you're going to put on them, how many days you're going to keep them on feed. Maybe you start locking in some of the feed prices that you need. If you need to buy additional corn and prices at a profitable level for you right now. See? Oh, I apologize for that. Maybe we can lock in some of those break-even prices for corn, or we make hay purchases now because we're afraid hay prices might go higher this winter for the feed value levels that we need. So really be evaluating those types of things, and then be monitoring what the markets are doing. I'm sure everybody out there is paying attention to what the fed cattle market's doing, and if there's a big uptick in the fed cattle market prices, maybe the cull cows are following that. And if there's an opportunity to sell at a profit, given the weight that you put on those cows already, maybe we take that, pull the trigger, and send them to the sale barn because we've hit that profit potential, and adding more pounds to them won't make it any better come later in the winter. So, really write that marketing plan down, create an idea of how long you're going to feed them, what's your end goal, what's your targets, and then monitor for potential changes when we can maybe increase our profit potential and move forward that way as well. So that's kind of the presentation I have here on the cull cows. I really hope that you move forward with the plan. If you want help working through your individual numbers, I would encourage you to give me a call and I can help you with that. Otherwise, if you visit the SDSU Extension webpage, we have all of our cow budgets online. They're in an Excel format, so you should be able to find them that way. Anybody have any questions related to cow markets and what the cow prices are going to do or have been doing? Don't see any microphones unmuting or anything in the chat box right away. I do want to share one more slide with you really quick here before I turn it over to Lisa. And that would be, well, I thought it was going to come up. SDSU Extension is joined with the South Dakota Counseling Association to host the South Dakota Farm and Ranch Stress Summit. The rains of this past week haven't made the stress situation any easier for anybody around the state, basically. But if you have friends or family, neighbors that are dealing with a lot of stress, maybe it's you that's dealing with a lot of stress, we'd really encourage you to attend and register for this conference. You can come for 1 day or 2. We encourage both days in attendance, but if 1 day works for you and you can attend, we would sure encourage you to do that. We've got a great lineup of speakers that are going to hit not only what's causing some of the stress, but maybe methods and some things to be watching for so that we can maybe get a control of, have an idea of what next year's weather is going to be, what next year's markets might look like, so that we make some of those plans ahead, in addition to having some of the breakout sessions covering different stress management techniques, ways that couples can work on increasing their communication or improving the way that they handle stress within their marriages, also dealing with kids and the families. If you've got young kids in your family or teenagers, if you're stressed, they're going to be stressed as well. So how do we work with within our families as we monitor these stressful situations? So the registration for this is also on the Extension website, and we would sure encourage everyone to sign up and join us in Owatcoma starting next Sunday. So if you have any questions on that, you can let me know that as well. With that, I believe, Lisa, I will turn it over to you, and we'll have our final presentation of the day. I'll turn it over to Lisa Elliott.
Okay. Hi, it's good to be with you today. Heather, I think you're going to have to make me a co-host so I can have privileges to share.
My apologies. I thought I had already done that for you.
Okay.
Okay. See if it did it this time.
Yep. Now I can do that.
Okay.
Yep. Just
Excellent.
a moment here. Okay. 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 Sure. Okay, can you see the PowerPoint now?
Yes, your slides are up.
Okay, great. All right, so today I will be speaking about winter wheat outlook, risk, and expected net incomes. And I do want to warn you, I have been having just a lot of difficulties here with my computer today with my screen blinking. But if this does happen, it should come back momentarily. So hopefully that won't happen. Okay. Okay, just a moment here to make sure I'm on, I have the right one up. Okay, I do. Okay. So first I'm going to go over and talk about fundamentals in the wheat market, and then I will discuss a little bit on technicals. And then the bulk of this presentation will be on revenue risk and expected net incomes. So fundamentals, looking at wheat usage, ending stocks, and price. So what we have here in this bar graphic is you can see the different components of wheat demand. And this light color, the light color green is for food. Feed and seed is a little bit darker green, and then the blue represents exports, while the white is ending stocks there. So that was our carryover from the marketing year 2018 and 2019. While we had a cash price of $5.20. Now, looking at the marketing year for 2019-2020, we can see a pretty similar picture here, just a little bit less for ending stock levels. And again, this is for the marketing year 2019 and 2020. And we can see the associated price pretty close to last year, farm price at $5.10. Now, if we look at ending stocks over time, this is for wheat, and this graphic goes back to 2004 to 2012. Right here is what we're able to see, and we can see how the ending stocks varied during those years. Then we can see when we move to 2013 to 2016, we start accumulating stocks over the years. So we're getting around the 1.2 billion bushels by 2016. We can see the following 3 years here were a little bit lower than 2016, but staying pretty close around where we were in 2016. So pretty relatively flat. We've decreased our stocks by a little bit. And then we can see the relationship between prices. So we can see still the ending stock levels, and we can see how that the prices changed over that time frame from 2004 to 2012. And so we can see that peak around 2012 for prices. And then we can see the association when we go from 2013 through 2016, we can see how each year we keep increasing our ending stock levels and how that associates with our prices going down from those peaks in 2012. And then we can see we've leveled off here. So from, we can see that prices, they've been kind of around this $5.25 over the past few years here. So where are we right now with accumulated exports? As you remember in that graphic, one of the components there was exports. And we can see the expectation is the yellow line. That's where we are expected to reach in the end of the marketing year. USDA expects around 25.5 million metric tons that the United States will export. And so by the end of the marketing year, we need to reach this line, and thus if we don't, we could have potentially greater carryover to the next year. So right now we can see this darker blue line. This is where we are currently for 2019. This was the path for accumulated wheat exports last year. And we can see that we need to basically continue on the track that we're on, if you think about a linear trend, to be able to reach that. So it looks like right now, if we stay on that trend, we should be able to meet that USDA export estimate. So just a couple of locations here for South Dakota for wheat bases. And we can see one point, the blue is for Winter, South Dakota, and the orange is for Gettysburg, South Dakota. And we can see that our basis level here recently kind of hovering around 15 cents under. So we can see if we compared to the quarter 3 of 2018, we were more around probably more typical levels of bases of around 50 cents under. So we've been strengthening bases over that time frame. So looking at just one technical chart here, if we look for July 2020 hard red winter wheat, we can see that we've come off of our peaks from the July time frame, and we've decreased down to around $4.34. And we can see if we were using, now this is just an example of a Bollinger Band, and we can see that, you know, we could use this in combination with in conjunction with our marketing strategies. If we wanted to use a Bollinger Band, we could, if prices go above that Bollinger Band, we could create a potential sell signal, and then thus we could also connect that with using options as well. So we could say we could sell a call or buy a put when the price crosses above the Bollinger Band. Likewise, you can see some different points here where it breached the lower Bollinger Band. So you could think about buying a call or selling a put when the price crosses the lower Bollinger Band here. So you can see we're kind of above. This is the brown. The brown line is the average line, and the purple is the upper band. So we're starting to get a little bit closer to that upper band there. And you can see back in the harvest time frame, a lot of volatility as the span between the upper and lower Bollinger Band is a lot wider than what we're seeing right now. So moving on to revenue risk and expected net incomes for wheat, soybeans, and corn. So we're going to focus more on wheat, but we'll compare that to soybeans and corn for two specific counties in South Dakota. So what I'll be showing is basically applied revenue risk. And we'll be looking at that. We'll be focusing on revenue risk and thinking about the price yield relationship, that historical relationship that we've seen with data. We'll look and incorporate expected yields and expected prices where we're utilizing simulation, where we are incorporating current prices and current price volatilities into our revenue risk analysis, and then coupling that with cost, and we're using the South Dakota crop budgets that Jack Davis, he puts together. So we're going to then couple that information to then be able to look at expected net incomes. And again, you know, what really is important, just like Heather was mentioning, that you are utilizing your own cost of production for doing these type of analysis, because your costs can vary greatly than what our budget estimates may be. So that's an important factor to keep in mind when we're showing our results. So we'll first start with our analysis for Coddington, South Dakota wheat. And in this, what we're doing is we're going to look at historical yields for Coddington, South Dakota for wheat. And according to this, we're projecting an expected yield in 2020 of 69 bushels per acre. And we're using NASS county level data. And as you know, so we have our expected yield. We also have with that uncertainty. So our uncertainty around that expected yield. And in this case, according to the historical data, it's around 19%. And so this is what we're utilizing for the assumptions of our analysis. and we have an expected cash price of $3.87. And again, with this price, we also have the price volatility incorporated as well. And this is based on futures prices. So this is at 18.5%. And with this, our expected basis is 43 cents under for our analysis here. So then what we can look at the simulated yield with cash price here. And what we're doing in the analysis is we are incorporating that relationship between price yield, in this case, slightly negative, not too significant, but slightly negative. So this relationship that we see here, this is incorporated into the analysis. So for wheat in Coddington, South Dakota, expected revenue we have showing here would be $266 with a minimum of 90, a maximum of 414. So you can see some of that risk there, how it varies from the min to max and expected revenue. And in this case here, we are showing that there's no insurance utilized, but you can see in the next graphic how incorporating insurance into the analysis, so having a revenue insurance at 75%, how that will change our min and max for our expected revenue. So you can see here, first we had a min of 90 and a max of 414, but incorporating insurance, we can see here how some of those lower observations of revenue were cut off. And so now our minimum is $202 per acre and a maximum of 514, okay? Now, if we take it a next step, so we were just talking about expected revenues, if then we want to get to potential net income, then like I said, just incorporating the cost from the South Dakota crop budgets, utilizing those direct cost of $224 per acre. And so we have a total cost before land of $297, and then incorporating land rental, we can see we have a total cost of $474 for total cost. So what we're showing here is that actually our expected net income for wheat in Coddington, according to these assumptions that we talked about, according to the cash price we expected, expected yields, and incorporating that variation around price and yield, we can see the expected net income would be negative $221 per acre, okay? And so basically what this is showing is there is a 50% chance of seeing better than negative 221 cents, but there's also a 50% chance of seeing even greater losses than negative $221 per acre for wheat. So the outlook in Coddington, South Dakota for wheat right now at the present time, it doesn't look too promising for positive net returns, for positive net income. And then if we want to compare this, so we think about, okay, so we saw the analysis for wheat, but how does that compare if we look at that for corn? So similar type of approach here. Again, we're using historical data, and we have, in this case, for corn, expected yield of close to 200 bushels per acre. We have an expected cash price for corn for $3.43, price volatility at close to 15%, and in our analysis, we have an expected basis of 62 cents under. So in this case, showing the utilizing insurance, so the same type of insurance that we showed for wheat. In this case, for Coddington, South Dakota corn, expected revenue here of $655 per acre. And I don't know if it cut off my PowerPoint. I think it might have, so I'll try and share that once again. Apologize for that. Hopefully we can get it up again. Okay. Okay, I don't know if you can see my screen again. I think my computer malfunctioned once again, unfortunately, but hopefully you can see my screen again. Let me know, somebody, if you can't, but what'd you say, Heather?
Your Coddington corn slide is showing?
Yeah. You can see it?
Okay. Yep.
Okay. All right, good. All right, so expected revenue here for Coddington, South Dakota. We've got the expected revenue, we said at $655. Min per acre, $482. And again, this has insurance, max of $1,122 per acre. Okay. Okay. So Coddington, South Dakota, now we're going to look for corn, the net income. So basically we're incorporating those crop budget costs, direct cost of $372 per acre, cost before land, which would be $469, and total cost of $646 per acre. So in this case, you can see not wonderful scenario, but a lot better than what we saw for wheat or Coddington. We can see that our expected net income would be at -$2 per acre. So a lot better than what we saw for wheat, where we saw $-221 per acre. So this is for, according to those assumptions that I went through for Coddington, we'd expect a net income of -$2 per acre, 50% chance of seeing higher, 50% chance of seeing worse than -$2 per acre. Okay, so then looking at the other comparison commodity in Coddington, for example, we can look at soybeans. And in this case, our assumptions include expected yield at around 46 bushels per acre, a cash price at $8.31, and our yield uncertainty around 20%, price volatility around 13.2%, and expected basis of about 98 cents under. So then taking it to the next level, incorporating revenue insurance at 75%, expected revenue for soybeans and Coddington. And this is something I didn't mention, but we're looking at expectations for these crops in 2020. Okay, so this is the expectation as we're utilizing those real-time prices for soybeans. We're utilizing the November contract in 2020. So this is all just looking at next year and thinking about potential planning decisions, basically from looking at wheat versus some other commodities here. So this is all expectations for revenue in 2020. So in this case, we have expected revenue at $363 per acre, a min with insurance at $277 for soybeans and Coddington, with a max of $673 per acre in Coddington. Now, again, taking it the next step, so we're just looking at expected revenue, but now incorporating our cost. So direct cost of $190 per acre, cost before land of $287, and total cost of $464 per acre. We can see that our expected net income in Coddington, South Dakota for soybeans would be negative $114 per acre here. So again, 50% chance of better, 50% chance of being worse off than that number there. So our expected net incomes when we're incorporating the price risk and revenue risk, which incorporates our yield risk, specifically for Coddington County, we can see if we're just comparing these three commodities and we're just comparing expected net returns, net income, and we're not thinking about any potential rotational benefits or anything like that, we would see the preferred choice would be corn, then followed by soybeans, and then third would be wheat. Okay, now looking at Lyman, South Dakota wheat. And again, same type of analysis using historical data here. Expected yield would be 44 bushels per acre. Cash price expected of $3.88. Expected basis 43 cents under. And again, we're incorporating insurance like we did in the previous examples. So our expected revenue here in this case for Lyman, South Dakota wheat would be $170 per acre, a min of $125, and a max of $342 per acre. And again, incorporating those costs from the budget. And again, you know, you really want to think about how your costs compared to this and think about that. But in this case, the direct cost would be $153 per acre. Cost before land, $209, and then total cost, $282 per acre. And in this case here, we are showing in Lyman, South Dakota wheat, 50% chance of being higher than negative $121 per acre, and 50% chance of being even lower at lower than negative $121 per acre. Okay, so let's now compare wheat to soybeans. And in this county here, we would be expecting a yield of 45 bushels per acre, cash price at $8.48, and expected basis again 98 cents under. And in this case for soybeans and Lyman, South Dakota, and again, you know, in all of these, it's incorporating the price-yield relationship specific to that county that we're looking at. And incorporating insurance, we would see expected revenue at $394 per acre, a min of $281, and a max of $961 per acre. And then our next step is incorporating the cost so we can get to an expected net income. In this case, we have direct cost at $136 per acre. Cost before land, $199 per acre, and total cost of $272 per acre, giving us here in Lyman, South Dakota for soybeans, an expected net income of $80 per acre with 50% chance of seeing higher than $80 per acre, and again, 50% chance of seeing lower than that amount. So then let's compare those results to corn. And corn, our expected yield would be 96 bushels per acre. Cash price, $3.41 here. And in this case, in Lyman, South Dakota for corn, there would be an expected revenue of $322. A min of $227, and a max of $670. Again, then we'll incorporate those budget costs. So we do have a total cost of $340 per acre, which then would give us a expected net income of negative $37 per acre for corn in Lyman County. So we can compare this expected net incomes for Lyman per acre for the different commodities here. And if we're comparing those, we can see, you know, the most preferred here would be soybeans, then followed by corn, and then third again would be wheat in this case. So the takeaways, again, just for fundamentals for wheat, again, we have a relatively large carryover, so that is suppressing wheat prices. And just to summarize some of the analysis from the Coddington and Lyman again, we can see in Coddington, the most preferred for looking into 2020 crop to be planted would be corn, followed by soybeans, and then wheat. And then in Lyman, it would be number one, soybeans, then followed by corn and wheat. Now, you can see our analysis, what we were able to show here. But if we see some changes in this ratio between basically looking at wheat versus the other commodities, then you could see potentially, you know, what would it take for example, in Coddington, what would it take for wheat to maybe be the second most preferred? And so that would actually, it would take a lot for that to happen. It would take, and you know, that's basically just considering, you know, current prices for all commodities. You know, if we're holding, you know, corn price constant, or holding soybean price constant, for it to just be even with soybeans, we'd have to see cash wheat prices at $6.87. While in Lyman County, for wheat to be the second most preferred, so it would be slightly just above corn for it to get to that level. Again, if we're holding basically current prices for soybeans and corn, you know, we're holding those constant, we would have to see cash price move up to $5.41. So that's just something, you know, with this analysis, just to continue to, you know, monitor that ratio between wheat to other crops when we're looking at the analysis, and just incorporating these net incomes according to our assumptions. So with that, I'll go ahead and take questions. Just want to point out, we do have different articles and YouTube videos about risk management and marketing. So that might be, if that's of interest, you know, you can go to our website and look at those. And if you have further questions, feel free to reach out to me through either email, or you can call me if you have other questions. So thank you.
Thanks, Lisa. We did have one question come through. The question is, do you have net income projections? Do they include market facilitation payments?
That's a really good question. Thanks for asking that. Actually, it doesn't include that. But basically, you know, if you wanted to include that, you could just adjust net income basically to incorporate that. But in this analysis, it wasn't directly incorporated, but it wouldn't be too hard to then incorporate that into the analysis, which would be a good thing to do as well. We might see a little bit different outcomes there. Any other questions?
Any questions for Lisa? Or any questions for Matt? I believe he's still available unless his phone call started. If you came up with anything regarding the feed situation. Well, not seeing a lot of activity being typed or microphones being unmuted. So as we're pushing that 4 o'clock hour, if Lisa and Matt's contact information were part of their presentations, I believe my information was all in the emails that you received when you got your email confirmation when you registered. So if you need to get a hold of us, please do that. And we're working on scheduling the October dialogue, so be watching for the advertisements for that program coming up. And if you have any topics that you want covered in any of our dialogues, we would sure appreciate that feedback from you. So with that, I will say thank you for joining us today. It's a pleasure to have you join us each and every time. Several of you are starting to be repeat attendees, and it's great to have you joining us. So with that, we'll say see ya. Good luck this week, and hopefully the creek don't rise.